Hello and welcome to Livewire's Buy, Hold, Sell. I'm Ali Selby and today we have a very special one for you. We'll be pitting fan favourites against each other in what we're calling the Battle of the Small Caps. Today I'm joined by Chris Stott from 1851 Capital and Marcus Burns from Spheria. Thank you so much for joining me, gents. First up, let's talk about your investment strategy. Both of you are bottom-up stock pickers. How much does the macro environment play into your investment decision process? I'll start on you, Chris.
Oh, look, it's always a critical factor overseeing what's going on at the moment. It's, the backdrop's probably the best we've ever seen it for a decade. Lower interest rates, low unemployment, wages growth is going to come back and inflation is going to come back, which we think is a good thing. So it certainly is a really critical, important factor in our overall investment process, but at heart we are bottom-up stock pickers looking for those companies that are growing no matter what the economy or the economic conditions present.
How about for you, Marcus? How much does the macro environment play into your process?
Yeah, look, I mean, it's a bit similar, Chris. We are bottom-up stock pickers. We focus on good cash flow businesses. I mean, I think the biggest change could be what happens to long-term interest rates, or at least perception of long-term interest rates. If they start to rise, I think a lot of the froth and bubble that's gone on in the short, in the sort of micro-cap end will probably come undone, and so that'll probably play pretty well into our style with cash flow as a key focus.
What kind of companies will flourish in this environment?
Ali, look, I think it's more about stocks that have valuation support. It'll do better than ones that don't have valuation support. So if rates rise over the medium term, which we think is likely, then stocks that have no valuation support or are priced off, extremely short-term fundamentals, I think could really struggle. Long-term input costs rise. I'm talking about labour rates here rising over time, and cost of capital. So anything that's very capital intensive, it requires increasing capital expenditure to kind of fund that inflation cost. If there's no pricing power, then those sort of businesses could really struggle in the current environment. Do
you have anything to add on the kind of companies that could flourish right now?
Oh, look, I echo Marcus's thoughts there around, we're looking for companies right now with significant pricing power. I think that's going to be really critical over the next few years as inflation returns to the system, and the ability for companies to pass those higher costs on to their, through their products is going to be really, really important going forward. And also, echoing the thoughts around having valuation support right now. We've seen the sell-off in the tech sector. A lot of these companies that have been red hot in the last 12 months, no valuation support, particularly those companies that obviously don't make money. So I think you'll see further downside to those particular stocks over the next 6 months.
Okay, let's talk stocks and get into the battle of the small caps. First up, we have mining services favourites NRW Holdings and Mader Group. Which of these two companies do you prefer and why?
Look, it's a very close line ball. NRW's been sold off significantly, so we are starting to have a good look at that again. But we would lean towards more Mader Group at this point in the cycle. They've got a better ability to recoup those high labour costs that we're seeing at the moment over in the West. So we'll lean, albeit very, very slightly towards Mader Group, but very much think that NRW is interesting at these levels.
How about you, Marcus? Which do you prefer?
Definitely towards Mader Group. Same as the rationale. I mean, it's got really good growth behind it. Very good management team. Valuations are very supportive. NRW, when it's taking on contracts, takes on quite a lot of risk with their contracts. So we find those type of businesses carry inherently more risk and thus real risk of not delivering or having cost blowouts, which we'd like to try and avoid.
I'll stay on you. Next up we have consumer staples favourites Temple & Webster and Scali.
Yep.
Both enjoyed massive success last year.
Huge success, yeah.
Yeah, which one do you prefer and why?
Oh, look, I think Temple Webster's done a great job at building that website and getting real traction. Obviously had a lot of benefit last year from COVID. People went online and stayed at home. But I think if I had to pick one of those two, we'd probably back Scali. The reason there is it's done incredibly well as well with real world retail. It's moving online. I think their business is probably a little more insulated from online because it's got very heavy furniture, which is hard to transfer online. But to the extent they'll push online, there's some growth rate there, and the valuation's more supportive than TBW.
How about you, Chris? Which one do you prefer?
Look, totally agree with Marcus. We'd lean towards Scali at a sixth of the multiple compared to Temple & Webster. Anthony Scali, in our opinion, is one of the best retailers in Australia. He's been through many, many cycles, and you want to own Scali at the start of a housing boom, and we think we're at the early stages of that at the moment. So we think that really Scali, with net cash balance sheet, are in a terrific position to take advantage of the strong housing market over the next few years.
Okay, speaking of housing, we have housing stocks CSR and Fletcher Building. Which of these two stocks do you think has the most room to run?
CSR for us. So we're quite attracted to the earnings stability in the aluminium space, particularly over the next 12 months with the hedging that's been put in place there. The land bank that's been released is certainly good from a balance sheet perspective, and we know what's happening in the housing market and the tightness in the particularly in the materials space. So CSR, we think, are in a great position to leverage that over the next couple of years.
Marcus, same question to you. CSR or Fletcher Building?
Well, interestingly, we're probably black Fletchers in this case. CSR's done a good job, sold off some assets, but we lean towards Fletchers. Fletcher's has got more exposure to New Zealand. Roughly 70% of the business is New Zealand, which we think is doing incredibly well. And the business in Australia has really got very trim margins, and there's tons of room, we think, for them to cut costs and expand margins in Australia. So net, we think there's more leverage there. They're also buying back their stock, which we think is a smart way to allocate capital. So at the margin, we'd back Fletcher's.
Okay, and last up we have healthcare favourites, Medicus and Healius, both within the diagnostic imaging arena. Which of these stocks do you think has more upside ahead of it?
Look, we'd back Healius despite Medicus' incredible run. I mean, PME's been a stellar share the last 2 or 3 years. We find the valuation pretty hard to substantiate at these levels. It's growing, but not anywhere near quickly enough in our view to kind of support the 100 times plus multiple it's trading on. Healius has got almost de-geared post sale of medical centres last year, and is getting a real benefit from sort of COVID testing right now. So it's definitely Healius over Medicus for us.
Chris, what do you think, Medicus or Healius?
Healius for us as well, purely on a valuation argument. Medicus almost at 150 times PE compared to Healius at around 18 to 20 times. So done a really good job there in terms of cleaning up the balance sheet over the last few years, and as Marcus said, exposure to the COVID testing, which we suspect will go on for a little while longer. So Healius for us compared to the other one.
And last up, I did ask our fundies to bring in one stock that they're really liking at the moment. Chris, I'll stay on you. What did you bring in for us?
Praemium, PPS is the code. So it's the number 3 platform provider in Australia behind Netwealth and Hub. Market cap of around 400 million. Recent CEO departures had no reason for concern in our opinion. The company at the same time announced a strategic review of their overseas operations, which we would see as a positive for the stock over the medium to longer term. So we quite like Praemium. It took out the number 4 player, Power Up, in recent times. So industry consolidation continues to occur in that space.
And Marcus, your time in the hot seat. What stock did you bring in for
us?
I'm
going to bring in a stock called Nitro Software. It's not particularly well known. NTO is the code. It does basically something similar to Adobe Acrobat and DocuSign in one. So it's sort of trying to disrupt those 2 American giants. It's priced at a big discount to those products, and yet the usability is quite proxy, quite similar to those 2. It's growing very quickly. It has an incredible retention of its client base, and we think it's got a really good long-term future.
Well, thank you for your picks, and thanks for watching. We hope you enjoyed this episode of Buy, Hold, Sell. If you did, why not give it a like? Remember to subscribe to our YouTube channel so you never miss another episode.